So, does the Fed think we're going to have another housing crash or crisis? Well, they're certainly not going to bail us out. So, welcome to Housing Bubble 2.0 News of the Week, or as I like to call it, another episode of As the Housing Market Turns or Churns and Burns. Randy Patrick here, putting the realism back in real estate. Yeah, it's been a while, and I've said that I was going to before pick up the pace on my videos, and I haven't. Reason being, it's not because I'm just lazy. It's actually because I'm out in the field doing a lot of cool stuff, right? So the market is changing. I can tell you that right now. Big difference as to what was happening a year or even 2 years ago, all right? Now, once again, this video is brought to you by our friends at Foreclosure.com. So if you're looking to get your hands on some cheaper or distressed properties, go to gethousingdata.com. That's gethousingdata.com. It's a very inexpensive way of seeing exactly what's going on in your real estate market. All right, so here's some cool stuff here. The Fed can't bail real estate out is a foreclosure crisis looming. So over the past couple of weeks, I've been seeing a lot more articles talking about the housing market, the changes in the housing market, the looming foreclosure crisis, as they're mentioning here, and looking at a lot of statistics and seeing what's happening in various metro markets across the country. Now, obviously, I'm in Tampa, Florida, so I'm focusing in on my market and, well, a lot of Florida, to be quite honest with you. I'm driving always all around the place. And we're seeing a ton and ton more of distressed properties. Now, it's one of those things that it's not like we're just seeing, investors or speculation. We're now seeing homeowners, a lot of FHA or VA borrowers that, have mortgages, have jobs, etc., but for whatever reason can't make ends meet. Maybe it's the economy issues, maybe it's changes in insurance and escrow and property tax increases, whatever. But either way, we're seeing a lot more newer vintage foreclosures basically pick up, and we're starting to see some of the older vintage ones actually start to come through fruition and hit for the foreclosure auction block, et cetera, et cetera. So basically, every so often, there's various data companies that put out monthly data or quarterly data, et cetera. We'll talk a little bit about that right now. But again, you're starting to see articles like this hitting the news or mainstream media. What I thought was interesting is that this is basically the Fed's most recent Federal Open Market Committee, or FOMC, meeting, which was held in mid-September. The minutes of that meeting were published just a couple days ago here in October, and they highlight, these minutes always highlight the overall economy, and they go into little blurbs about, inflation and this and that and whatever. But they actually had kind of a paragraph on housing. And I'm not going to read the whole paragraph. The underlined part, the bold and underlined part, really is pulled out of the main body here. So they're talking about the housing markets, all right, and basically saying several participants noted continued weakness in the housing market, and a couple of participants mentioned the possibility of a more substantial deterioration in the housing market as a downside risk to economic activity. So what that basically means is, I guess, the people who run part of that FOMC meeting, the board, chairman, people, whatever, regional feds, executives, they're chiming in saying, hey, everything is not, hunky-dory here. We're not looking through the market with rose-colored glasses. We're seeing some weakness, and the weakness will continue, and we may see a downside or a substantial deterioration. So it's one of those things where, for me, when certain people or certain organizations are starting to talk about this, they're laying the groundwork for something, that's yet to come, maybe worse, that's coming down the road here. And, it's easier to start to talk about it maybe months or years in advance, as opposed to, hey, the next day we're in a housing crash. What are we going to do here, right? So this is where I'm seeing a little bit different. Before there was denial, now we're starting to see it opening up to be a little more, a little more acceptable to talk about this. Now, for example, this is just a recent thing I saw on the internet on a Facebook page, hit my feed here. But if you think about it, this is indicative to what's happening here. So top 10 metros with the highest foreclosure rates. Well, I think this was maybe the August or September. I think it's the August numbers. It's foreclosure rates, which typically is, it's per one foreclosure per X number of households. So the lesser household, which means the worst rate. So Lakeland, Winter Haven, Florida was number one at the time. Columbia, South Carolina, number two. Cape Coral, Fort Myers, number three. The Cleveland area, number four. Ocala, number five. Jacksonville, number six. Bakersfield, California, number seven. Palm Bay, Melbourne, Titusville area, that's the East Coast, sort of a little bit north of where the Cape Canaveral is. That's number eight. Vegas area, number nine. And Jacksonville, North Carolina, not to be confused with Jacksonville, Florida, which is already up there, number 10. Now, one of the things that I want you to notice is that, gee, I've got 5 of the top 10 and number 1. So number 1, 3, 5, 6, and 8 are in the state of Florida. Obviously, California is going to ebb and flow, Bakersfield being the one there. We've got Reno, Nevada, sorry, not Reno, Las Vegas area. We've got the Cleveland area, which is always up there. South Carolina, obviously, there's always something going on in South Carolina, Columbia, and obviously we've got the Jacksonville, North Carolina area. So I can tell you firsthand knowledge that, yeah, all these locations in Florida are suffering big time. And it's funny, so different cities will make the top 10 or whatever based on their foreclosure activity or filing activity, whatever. So next month, it could be Miami-Dade area is the number 1 leader in foreclosure rates, etc. So again, this is foreclosure rates. This is not actual physical pay count filings, which, you'll be surprised when you actually kind of see those as well too. So let's move to the next slide here. So one of the cool things that, again, like this is, they're talking about it now, guys. So I just said, okay, let's check this out. And I asked AI, artificial intelligence, I said, okay, let's talk about, what constitutes a housing bubble. Because, for regardless of the economic conditions of housing, you're always going to have, a certain number of people saying we're not in a bubble situation. There's no crash happening. Randy, you're smoking crack type of thing. And then there's the people who, like us, which are called the housing bubble bros and the doom and gloomers, which I refer to myself as a realist, to be quite honest with you. It's kind of like this. What reasons are could you suggest that are contributing to potential housing bubble / crash? Now, I think you can sort of say that we're in a bubble. All you have to do is look at the recent Case-Shiller information to see how far much higher we are compared to the last bubble. Okay, so it's very substantial from the 2006 bubble to where we are today. So bubble is here, but this kind of gives some edification to it. Well, why do you have bubbles? Well, easy access to credit, with these low interest rates or loose lending standards. People always want to talk about loose lending standards from back in the day. It drives prices up artificially. Okay, speculative buying and fear of missing out. So speculators, investors, obviously are pushing the envelope. Fear of missing out, FOMO. Okay, when people see prices rising fast, they rush before they get priced out, and basically people enter the market thinking they can buy and resell to make a quick I guess you say profit, which the speculative demand pushes prices even higher. But it's all on, okay, if it went up 10% this year, it's going to go up 15% next year. The concept or the mindset is, hey, if I have to sell, I'll break even, or maybe I'll make a few points, right? But people don't actually realize that they could lose money in this type of environment. Limited housing supply. In many cities, there's not enough housing to meet the demand due to zoning restrictions, permitting, land scarcity. Builders can eventually overreact and overbuild, contributing to a bubble bursting later, which is what they are doing. We have a very, very high level of builder inventory right now in the market. Inflation and asset chasing. So basically, real estate is considered a safe haven for to put your money because it's tangible, physical, and people rather play that game than the stocks or maybe crypto. Institutional investors, funds, hedge funds, REITs, whatever, they pour capital into housing. Now, realize that those groups are looking to make an average annualized return on investors' money. They're not an individual looking to buy and sell and make profit, etc. So there's a little different mindset when it comes to the institutional guys, but they they put their toe into the market, and a lot of people can think, have maybe I wouldn't say think or blame housing bubbles due to investors and the large buying funds, etc. Okay, psychological factors. People believe real estate always goes up. You ignore the historical corrections. It creates herd behavior. Buyers, agents, lenders believe endless price growth is guaranteed. So when things are going up, people get into the market. More investors come in. More people take training courses. You have more real estate agents, people applying to become a real estate agent, loan brokers, whatever. So all that swells, and they say here to media hype and viral social media trends reinforce the cycle. Government or policy distortions, subsidized lending, tax incentives, aggressive monetary policy can help prop up the demand. Obviously, we've had ultra low rates over the past number of years, decade plus, to boost price, well, to boost activity, right? Quantitative easing, but now we're starting to pay for it. And disconnection between prices and fundamentals, all right? What that basically means is the fact that when home prices outpace wage growth and rent values, affordability collapses. So we are basically in an unaffordable market right now. That has happened. If you take a look at historically over the past decade, or even coming out of which is about the decade, I guess you could say, coming out of the recovery of the last housing crash and crisis, you can see that prices were going on a pretty high pace on a linear basis. Then once COVID hit and everything shot up almost exponentially, well, wage growth has not matched that pace. Okay, that's actually been more of a separation as time has gone on. So basically, demand will cool and buyers won't pay inflated prices. So that's where we are right now. So we've got more inventory, longer days on market, more price drops, more concessions. Interest rates are still too high. They've not come down. And the Fed's making little changes here and there, may not stimulate because it may not apply to mortgages, right? The short-term rates. So guess what? We're kind of in the situation of what's going to happen. What they don't even talk about here, which I find kind of interesting, is what we call, I look at delinquencies and things like that. But as a subsequent to the AI stuff here, it says key indicators suggesting elevated risk, which is for right now. So once I put that in AI, the question is, what constituted the signs of a housing bubble? They said, do you want to look at today's market in 2025? I said yes, and this is what I got. Home price to income ratio very high. So yes, the median price for a single family home now rose to 5 times the household income. That's a record high. In comparison, the late 90s had around the 3-to-2 ratio. So there you go. The fact that it's back to near peaks is concerning. Mortgage delinquencies and strain among borrowers. Overall delinquency rate for 1 to 4 units is about almost 4% of loans outstanding, slightly below historical average rate, but relative low in recent years. But we're seeing higher increase in FHA loans and VA loans of delinquency. And as I mentioned, I'm seeing a big push for people calling us for short sales and things like that, or trying to unload their properties because of personal economic situations in almost brand new houses. We just grabbed one about a week and a half ago. It's a townhouse not far from us, maybe about a half hour away here. Townhouse community built in 2023. So there you go. You buy it in 2023. Here we are 2 years later, and for various reasons, economic reasons, you can't afford anymore to make that payment. So you're going to stop making the payment, and then nature will take its course. So we're seeing better properties falling into the foreclosure, I guess you could say, realm here, right? Obviously, VA back loans, same thing. These are often first-time home buyers or lower down payment credit borrowers, okay? So that's kind of the situation we're in here. And also, some regional risk from natural disasters push up delinquencies in Florida and Georgia. So yes, there are delinquencies with respect to the flooding and some of the hurricane damage that's happened that's contributing. So basically what I'm seeing in Florida, and particularly the west coast of Florida, there's a lot of stuff happening, a lot of things going on. It's not just my location. You can see it's Jacksonville, it's Orlando, it's Ocala, it's Miami-Dade. If you go West Palm County down to Miami-Dade, big time volume of pre-foreclosure. So it is actually happening right before our eyes, all right? Now, obviously, what the neat part about it is we see people with money, if you can, a lot of cash buying. So the higher share of cash buyers just happened in Q2, 33%. Basically, these buyers are less sensitive to mortgage rates and sometimes less sensitive to income constraints, so it's easier for cash people to buy. Basically, affordability is having a hard time. Why? High interest rates and mortgage rates in demand. They're still elevated, 6 to 7%, and people are getting priced out and they're waiting for rates to fall. But as we said earlier, that we may not see, or there's not a suggestion that we're going to see lower mortgage rates over the next little while. Like we had a little blip after the Fed announced their cut, a few weeks ago, but I think rates either held or have gone up a little bit since then. So, again, when the Fed cuts their rate, it doesn't always affect the mortgage rate. It affects other rates in the financial world here. So you have to be aware of that. So, this is just where we're at. So I'm seeing so many things that are going on here. So from your perspective, if you're looking to get into this marketplace, this is the stuff we do, okay? So all this distressed property and pre-foreclosures, you get involved in all these things here. Bank-owned, foreclosure auctions, you can do that. Subject to, I know a lot of people like to do the subject to deal. We do that. We do wrap mortgages, okay, on our creative finance deals. Short sales and short payoffs, we're doing that. Homeowners associations and condo association foreclosures are picking up. like tax deed foreclosures, everything else I'm talking about, underinsured with the flood and hurricane, bankruptcies picking up, surplus and overage, note buying, all these and little ones in the middle that I didn't even talk about here. So my point to you is that there is so much happening right now in the market. But the real issue is it's not on the surface. So in other words, you're not going to look at the MLS and go, oh, I see 1,000 short sale listings, in my metro area. I'm going to start to bid or try to buy one. You're not seeing that right now. The reason being because a lot of the stuff has been just accumulating and growing what I call under the radar, like shadow inventory. All right. Now, as time kicks on here, eventually you're going to see more and more of those properties hitting the MLS to work with real estate agents, etc. Now, that's great if you want to buy something. We go after off market and convert them into deals that way. All right. Because I don't want to deal with a real estate agent who's gatekeeping or playing their control game when they're doing a short sale when they don't really know what they're doing. Yes, that's coming from an experienced short sale or distressed property person and knowing the game for how many years now, right? So it's the way it goes. I'm very cynical and sarcastic when it comes to that. So here's the scoop, guys. Reach out if you want to talk about this some more. I'm going to try to do some more videos, but a lot of the stuff that is actually being published right now is talking about foreclosure volume, foreclosure issues, VAs, FHA. There's been changes in the industry that's going to cause probably some more default coming our way. We basically have had about 5 years of, we'll call it protection with government, programs, etc., forbearance, home retention programs. They're reluctant to actually force people, into the foreclosure process when their home retention programs don't really work. There's been a lot of that being held back. So now I think the marketplace is saying, we can't keep floating this economy and these people in these houses. We got to start acting accordingly. So that's where we're at with respect to the housing market. Next one, I'm going to delve into the actual foreclosure filings across the country. You'll be surprised, you won't be surprised. But as I said, every month, every quarter, different properties are in the top 10 or top couple positions. There's always the traditional people in there: Florida, Texas, California, Nevada, New York, Illinois, Ohio, those, South Carolina. We're always seeing those states, and then eventually the metro locations up in the top foreclosure filing. I guess you could call it charts, etc. So anyway, guys, appreciate your time in the video. Please like the video if you enjoyed it. Please subscribe. I'm going to try to build this channel back up again and be more interesting here. And I hope everybody has a good day. I look forward to talking to you very shortly.